Stop scrolling. What I'm about to tell you in the next 30 minutes will do more for your bank account than the last 10 years of your life combined. And I mean that literally. 90% of people you know will never be wealthy, and it has nothing to do with luck. And it has nothing to do with how smart they are. It's because they are making 3 or 4 specific mistakes with their money right now, today, without even realizing it. And those mistakes compound quietly in the background until one day they wake up at 50 years old wondering where all the time went. I've built and lost fortunes. I've sat in rooms managing billions of dollars where one wrong decision could have wiped out everything in an afternoon. So when I tell you money has rules, actual rules, not luck, not magic, I need you to take that seriously. Turn your phone away from you right now. Give me 30 minutes with 0 distractions. And I promise, by the end of this video, you will think about every single dollar you touch completely differently for the rest of your life. Before I go any further, I want you to do one thing for me. Hit subscribe right now. I'm not asking for a favor. What I'm about to give you is worth more than any financial advisor is going to charge you thousands of dollars for, and I'm giving it to you for free. The only thing I want in return is that you're here when the next one drops, because this is a series, and each piece builds on the last one. So subscribe, then keep watching, because we're just getting started. Let's talk about the first thing that almost nobody understands, and it's this. Money is not made by being smart. Money is made by being disciplined. I've sat across the table from some of the sharpest minds on this planet, PhDs, people who could tell you the GDP of every country from memory, and half of them are broke or close to it, because intelligence without discipline is like a Ferrari with no brakes. You're going to crash. It's just a matter of time. The people who actually built wealth, the ones who quietly become worth 10, 20, $50 million over a lifetime, they aren't the geniuses. They're the ones who figured out a simple system and then had the patience to stick to it for decades without blinking. Here's the system, and I want you to actually write this down. When money comes in, the first thing you do is pay yourself. Not the landlord, not the credit card company, not the restaurant. You a fixed percentage. Doesn't matter if it's 10% or 20%, goes straight into an investment account before you touch a single dollar of it for spending. Most people do the opposite. They spend first, and if there's anything left over at the end of the month, that's what they save. That's backwards. And it's the single biggest reason why people who make good money still end up with nothing in the bank 30 years later. Flip the order. Pay yourself first, spend what's left. It sounds almost too simple to matter, but I promise you, this one habit alone will put you ahead of the majority of people. Let me give you a real example of how brutal this math gets, because numbers stick better than advice does. 2 people, same age, same starting salary. Person 1 saves 15% of every paycheck starting at 22 years. Person 2 says they'll start once they're making more money, once things settle down, once the timing feels a little more comfortable. Person 2 starts at 35 instead. Same income, same investment return, same retirement age. Person 1 ends up with roughly double, sometimes close to triple, what person 2 ends up with, purely because of those 13 extra years of compounding working in the background, not because they were smarter, not because they picked better investments, just because they started the habit early and never stopped. That gap right there, that 13-year head start, is the difference between retiring comfortable and retiring worried. And it all traces back to one decision made early and repeated automatically every single payday without having to think about it twice. There's one more piece to this system that people hate hearing, and it's debt. Not all debt is the same, and I want to be clear about that. A mortgage on a home you can genuinely afford is very different from carrying a balance on a credit card at 20% interest. But high-interest consumer debt is one of the single biggest wealth killers I have ever seen. You cannot outinvest a 20% interest rate. It's mathematically impossible for the average person. So if you're carrying that kind of debt, the plan changes slightly. The first priority becomes crushing that debt as aggressively as you can, because paying it off is effectively a guaranteed return that no stock market can promise you. Once that's gone, then the full system. Pay yourself first, invest what's left, kicks in at full strength. Now here's where it gets interesting, because saving money is only half the battle. The other half, and honestly the more important half, is what you do with that money once you've saved it. This is where I've watched people make the most catastrophic mistakes of their entire financial lives. They save diligently for years, and then they either freeze up and let it sit in a checking account earning nothing, or they panic and throw it at whatever's hot that week because their neighbor made money on it. Both of those are losing moves. Let me tell you what winning looks like. Winning looks like understanding that time in the market beats timing the market almost every single time. I've made a career out of moving in and out of positions, reading the macro picture, betting big when I saw something the market hadn't priced in yet. But that's a full-time job. And it's not what I'm telling you to do with your own money. For the average person building wealth over a lifetime, the game is completely different. The game is to get your money into productive assets, things that grow in value or produce income, low-cost index funds, real estate you can actually afford, a business you understand, and then leave it alone. Let compounding do what compounding does. Albert Einstein supposedly called compound interest the eighth wonder of the world, and whether he actually said that or not, the man was right about the math. A dollar invested at a reasonable rate of return, left untouched for 30 or 40 years, turns into an amount of money that will genuinely shock you. The problem is nobody has the patience for it anymore. Everybody wants to get rich in 18 months. I'm telling you, the boring path is the path that actually works. I've spent my career hunting for the big macro trades, the moments where you can see something the rest of the market hasn't caught on to yet. And there's nothing more exciting than being right on a huge bet. But I want to be honest with you, that game is not built for the average person trying to build their retirement over 40 years. It requires full-time attention, decades of pattern recognition, and a stomach that most people simply don't have and shouldn't need to have. For you, the goal is not to outsmart the market every quarter. The goal is to own a piece of the economy's growth for as long as possible and get out of your own way. Every time you check your account daily, every time you react to a headline, every time you sell because something dropped 10% in a week, you are fighting against the one force that's actually supposed to be working for you. Set it up, automate it, and then go live your life. The account will do the rest. Let's move to something I care about more than almost anything else in investing, and that's risk management. This is the part that gets skipped in every single one of these get-rich-quick conversations. And it's the part that actually determines whether you keep your money or lose it all back. I've seen brilliant traders, guys who called the market perfectly 3, 4, 5 times in a row, blow up their entire account on the 6th trade because they got greedy and they didn't respect the downside. Here's the rule I've lived by my entire career. It's not about how much you make when you're right. It's about how little you lose when you're wrong. Think about that for a second. If you make 50% on a position and then you lose 50% on the next one, you are not back to even. You are down. Losses compound against you faster than gains compound for you. That's just math, and it's brutal math if you ignore it. So what does this mean for you sitting at home trying to build wealth the normal way? It means never put yourself in a position where one bad month, one bad year, one emergency can wipe you out. That means an emergency fund before you invest a single extra dollar, 3 to 6 months of expenses sitting in cash, boring, unsexy, earning almost nothing. But that fund is the thing that stops you from having to sell your investments at the worst possible moment because your car broke down or you lost your job. Every wealthy person I have ever met, and I mean every single one, has some version of this principle. Protect the downside first. Chase the upside second. Do it in the other order and you will not be wealthy. You'll just be lucky for a while, and luck runs out. I've watched entire fortunes disappear in a matter of days because somebody refused to admit they were wrong. That's the other piece of risk management nobody talks about. Being willing to cut a loss and move on without your ego getting involved. The market does not care about your opinion. It does not care how confident you were, how much research you did, or how sure you felt when you put the money in. If the facts change, or if you realize you were simply wrong, the correct move is to get out and preserve what you have left, not to double down out of stubbornness hoping it comes back. I've seen this exact mistake take down people with more. talent than I have. They fall in love with a position the way you'd fall in love with a person, and they can't let go even as it's costing them everything. Wealthy people are not the ones who are never wrong. They're the ones who are wrong. Quickly admit it and move on before the damage compounds into something they can't recover from. Now let's talk about something people really don't want to hear, and that's the value of your own income and your own skills, because your ability to earn money is actually the biggest asset you have, especially early on. Most people obsess over which stock to buy or which crypto coin might go up next week, and they completely ignore the fact that the fastest way to build wealth in your 20s and 30s is to dramatically increase what you earn. If you're making $40,000 a year and you manage to get that to $80,000 over the next 5 years through a skill, a certification, a job change, starting something on the side, that is going to move the needle on your net worth far more than picking the right stock ever will. I always tell young people, figure out what you're naturally good at, the thing that comes easier to you than it does to most people, and then get obsessively good at it because the market pays enormous premiums for genuine skill. A person who is excellent at something rare gets paid completely differently than a person who is average at something common. Once you've built that income, that's when the saving and investing habits I talked about earlier start to really compound, because you're not fighting over scraps. You've actually got real capital to put to work. So don't just think about your portfolio. Think about yourself as an asset. Invest in your own skills the same way you'd invest in a stock you believed in. And here's something that ties directly back to what we talked about earlier with debt and discipline. As your income grows, the temptation is to grow your spending right alongside it. New car, bigger apartment, nicer vacations, because you feel like you've earned it. And in a sense, you have. But if every raise gets absorbed by a lifestyle upgrade, you can double your income and still end up with the same $0 left over at the end of the month that you had before. The people who actually get wealthy from a growing income are the ones who keep their lifestyle roughly flat, while the gap between what they earn and what they spend gets wider every single year. That widening gap is what fills the investment account. It's not glamorous, and honestly, it can feel like you're missing out while your friends upgrade everything around them. But 5 or 10 years down the line, you're the one with real assets, and they're the one still living paycheck to paycheck no matter how much their salary went up. Here's a mistake I want to warn you about directly, because I've watched it destroy more people than almost anything else, and that's the comparison trap. Somebody in your life is going to buy a new car, post a vacation, brag about a stock that tripled, and it is going to make you feel like you're falling behind, like you need to do something drastic right now to catch up. Resist that feeling with everything you've got. The people who quietly build real wealth over decades are almost never the ones showing off. In fact, a lot of genuinely rich people I know drive normal cars and live in houses that would surprise you with how modest they are. They understand something the flashy crowd doesn't. Wealth that you can see is often wealth that's already been spent. The real wealth is sitting quietly in an account compounding untouched, unbothered by what anyone else is doing. The moment you start making financial decisions based on what other people think of you, you have already started losing. Every unnecessary purchase made to keep up appearances is money that will never get the chance to compound for the next 30 years. Multiply that by every year of your working life, and you start to see just how expensive insecurity actually is. Build your plan based on your own goals, your own timeline, your own numbers, and ignore the noise. It's genuinely one of the hardest things to do, and it's also one of the most profitable habits you will ever build. I'll tell you something that took me years to fully understand. The people who are the loudest about money online are rarely the people who actually have the most of it. Real wealth tends to be quiet, almost boring from the outside, because the people who have it aren't trying to prove anything to strangers. They already proved it to themselves years ago through the discipline of sticking to a plan nobody else could see. So when you're scrolling and you see somebody flashing something that makes you feel small, remember, you're looking at a highlight reel, not a bank statement. You have no idea what debt is behind that car, what stress is behind that vacation, what's actually sitting in that person's savings account. Comparing your entire financial life, which you know every detail of, to somebody else's curated 5 seconds of video is one of the worst trades you can make. And it costs you more than almost any bad investment ever could. Let's finish with the mindset piece, because none of this works without it. Building real wealth is not a straight line. There will be years the market goes down and your account loses value even though you did everything right. There will be moments you feel like you're behind everyone your age. There will be temptations to abandon the plan because something else looks like it's moving faster. I have lived through market crashes that wiped out huge portions of paper wealth in a matter of weeks, and the people who survived those moments and came out ahead were never the ones who panicked and sold everything at the bottom. They were the ones who had already decided in advance what their plan was, and they trusted it even when it felt terrible. That's the difference between an investor and a gambler. A gambler reacts to what just happened. An investor has already decided what they're going to do before it happens. So set your plan now while things are calm. Decide what percentage of your income you're saving. Decide what you're investing in and why. Decide that you are not going to touch that money for years unless it's a genuine emergency. And then when the hard moments come, and they will come, you won't have to make a difficult decision pressure because you already made it back when your head was clear. I remember watching markets fall apart so fast that people who had spent decades building wealth watched huge chunks of it evaporate on a screen in front of them within a matter of days. It's a sickening feeling, even for people who have lived through it many times before. And in every single one of those moments, the story that plays out afterward is always the same. The people who sold in a panic locked in the loss forever. The people that had a plan, who understood that markets would recover, who kept adding to their positions on schedule even when it felt insane to do so, were the ones who came out the other side, further ahead than before it happened. The market rewards patience in a way that almost nothing else in life does, and it punishes panic just as consistently. If you take one thing from this entire video, let it be that your behavior during the bad years matters more than your strategy during the good ones. Anyone can hold on when things are going up. Wealth is actually built in how you behave when everything looks like it's falling apart. So here's your challenge, and I want you to actually do this, not just nod along and forget about it in 10 minutes. Before the end of today, open your banking app and set up an automatic transfer, even if it's a small one, into an investment or savings account. Time for the day you get paid. That's it. That one action done consistently is worth more than every stock tip you'll hear this year combined. If you do nothing else from this video, do that. I'm not going to pretend that one transfer today makes you wealthy tomorrow. It doesn't work that way. And anyone who tells you it does is selling you something. What that transfer actually does is start the clock. It puts time on your side instead of against you. And time, more than any stock pick or hot tip, is the one advantage every single person watching this actually has access to right now, regardless of how much you make or where you're starting from. 90% of people will watch a video like this, feel motivated for about an hour, and then go right back to exactly what they were doing before. That's the honest truth. The 10% who actually do something with it, who set up that transfer, who commit to the plan, who protect the downside and let compounding handle the rest, those are the people who look back in 20 years and can't quite believe how far ahead they ended up compared to everyone they started even with. And if this actually helped you see money differently, share it with one person in your life who needs to hear it. Because most people never get this conversation. And most people never will unless somebody who cares about them sends it their way. Subscribe if you haven't already, because next time I want to walk you through exactly how I think about risk when the market gets scary. And that lesson alone has saved me more money over my career than almost anything else I've ever learned to. Go set up that transfer. Do it today, not tomorrow, not next payday. Today, I'll see you in the next one.